Hi, before we get started, can somebody confirm that they can hear my voice? Thanks. So great, now that you guys have confirmed that I'm audible, um, let me kind of talk briefly about today's session and then we'll go deeper, right? So my name is Rahul Bide, and I have at least 2 decades of experience, building software products, as well as taking products to market, the whole GTM strategy, as they call it, go to market, and then selling these products in the market, right? So you guys, be it mechanical, be it electrical, be it electronics or computer science, does not matter, which engineering you guys are doing. Um, what really matters is whether you have kind of that holistic view of how a company is run and what are the important things that the top management in a company look at when they are running it, and if the company is run in a healthy manner, if it's a healthy company, right? So there are multiple indicators, almost like a health indicator, right? I mean, you guys are well versed, if you are asked, how is your health, um, you can always say, the health is good, the health is not so good, or whatever. But you can actually give numbers, right? You can actually state your health in terms of quantity, that my body temperature is this, my blood glucose level is that, my heart rate is this, my resting heart rate is that, and so on, which gives a clear indication of a person's health. And then you can take a lot of decisions based on these quantities, right? If you go to a doctor, the doctor, once they know that, oh, there is 101 fever, the doctor might take one course of action, one course of medication. If the doctor finds it is 102 or 103 or 104, the doctor will change the kind of action that they might take, right? So very similar to that, companies also operate basis various parameters, various data points that they receive as a part of monitoring the company's health. And the biggest one is whether your company is making money or they are not making money, right? Whether they are, um, you know, getting a good return on the investment and returning that to the investors, or they need to do something else, right? So there is a lot of planning that happens, and that planning kind of starts when you have a top target decided for a company. So the top target could be that, hey, you want to achieve X percent of growth or Y percent of um, profitability, or it could be a combination, right? So growth plus profitability, will come to that. It's called a ratio. It's a very popular term which you will get to know today. I will not disclose it right now, but as you hear the the session, you will get to know what is this magic percentage that companies look at to decide whether they are healthy or not. And there are so many other ratios, right? It's like studying various parameters to make a stock investment decision, right? So there are so many of these that you will run into. We are not going to, it's a very, very vast topic. We are not going to be able to do a lot of justice diving deeper into every aspect. But you will get enough understanding as an engineer, even if you are not in finance, even if you are not going to be, or immediately are not going to make any executive decisions on products or launching products in the market. Still, you should know and understand what are the triggers to those decisions, right? And more often than not, the triggers are financial triggers, right? So finance kind of controls what engineering produces, and then kind of almost gives a direction to engineering, right? So that is one of the top reasons. And of course, the second big reason, and I'm bringing this up because this question was asked in the last session as well, that what is the benefit of learning all of this for a mechanical engineer or for a computer science engineer. I'm going to be a coder, I'm going to be a programmer, I'm going to be a data scientist. What is finance of any use to me, right? So there is a lot of benefit, though you may not be working in finance. Remember that the work that you're going to do forever in the future is going to be governed by one or two financial aspects, right? And we'll try and study as many of them as we can today. All right. So far so good. Can you guys give me a thumbs up if you have been able to hear me okay? If yes, then we'll proceed further. Okay, great. The big aspects of this is, understanding how for-profit companies make money or lose money, right? And why do they lose money? How do they plan for the coming future? How do they plan for a 3-year goal versus a 1-year goal versus what they're going to deliver in 6 months? So we'll talk to some of the aspects of this. We'll also talk. That's called annual operating plan. Um, and then we'll also talk about um, company financials. Meaning, I'm not going to help kind of analyze companies from uh, a, a stock tip perspective, or a perspective of figuring out whether you should invest in that company. But this is more from the perspective of what does the CFO look at, right? What are the top few you know activities, or what are the top few necessary literacy that everybody needs to have in as you get into corporate life, right? So so financial literacy is not just for accountants. It is actually a critical skill for engineers to understand the personal or the departmental impact of their work. um, Again, I may be generalizing that engineers do technical work only. That may not be the case, but either way, uh, every person now getting into the corporate world needs to have that financial literacy. It just helps you answer the why question better. Why am I doing what has been assigned to me? Oh, my manager told me to do this. Why? Right? And the financial lens, more often than not will help you get that answer. Okay, so you must recognize that management and the investors, they use all these numbers, right? The financial numbers as well as the annual operating plan numbers, to help make decisions, right? To help build a future strategy, make it imperative to understand, and that exactly makes it imperative for us to understand how the corporate machine looks like, right? So we'll go through this, and needless to say, as we are talking about various aspects, there is plenty of material available online. Um, Two key sources that I would point to you. One is Investopedia, where there are clear definitions of what EBITDA means, and we'll talk about it a little more, or what profit before tax means, what does tax mean, and so on, right? So there are multiple of these very fundamental definitions which are clarified, and then there are lots of clarifications around many of the terms that we are going to talk today, right? So Investopedia is one. The second one is, of course, all these websites who can analyze various different companies for us. So over the several lecture series of Satkam, you may have heard about how do you understand a company, right? From various different aspects, from specifically those four aspects that we mentioned. How do you understand a company? The domain, the customer, the product, and the strategy, right? Um, you will get that kind of understanding on various different websites nowadays. So money control, value research, screener, finance.yahoo.com, Google's finance website, a lot of kind of analysis of listed companies and sometimes unlisted companies also is present there. You will get to understand various different terminologies if you go deeper into understanding that company. And we'll look at some of that in today's lecture also. All right. So, employees or new job seekers, they need objective data points to understand the company's health. Okay. As we all agree, um, if it cannot be measured, it cannot be fixed, right? And what is not measured is not true, which basically points us to, again, data and data analysis. And today we'll talk about financial data, but that financial data is informed by various other data captures that happen within a company, right? And primarily it is helping with, it gives us kind of this operating view of the company, whether the company is healthy or not. This helps drive strategy and financial planning and analysis. For example, you decide to build two products, okay, two flavors of the same product, and 6 months down the line, you realize that one is doing better than the other. Though you had plans to build both the products out, you will obviously, stop producing one and put all your money, all your focus on the other one, which is doing well, right? So those are kind of the continuous decisions that are made by various executives in the company, and heavily used for planning and accounting for the future. I mean, accounting for the past and planning for the future, right? Um, so today's lecture is divided into two modules: corporate finance foundations, covering statements, rule of 40. So we'll talk about rule of 40 quite a bit today. Um, we'll talk about annual operating plan, and we'll take a case study. Okay, we'll straight jump into that in a second, and this is how the session will be. At divided into various smaller topics, and we'll see. We have time to cover much of this, but overall, this is such a vast topic that it cannot be covered in 1 or 2 hours. It will need a lot of self study after you have gone through this lecture, right? So hope this helps you. All right. So the first one that we'll talk about is an income statement, right? So there are various different um, statements or data slices, financial data slices that the company looks at, right? And one of that is the income statement. So think of an income statement as total energy flowing in, like it's like the the petrol that you fill in your car, right? So the total fan energy in, and then there are thermal and systemic losses. Somebody's car engine gets overheated, somebody's car engine is not the firing to the best efficiency. It doesn't mean that the car cannot move from point A to point B. It only means that the car is not efficient enough, meaning the output which is moving from point A to point B with a certain kind of payload, that differs in every car. So how much do you maintain the car? How critically do you look at kind of this spend, right? So the input is the energy in, which is the income, and the expense is the losses that happen, right? What remains with you is workable energy, right? Which we call as net income. Okay, so revenue minus expense is your net income, and the goal of all for profit companies is to maximize this net income. So we want to minimize the expense. So first of all, we want to maximize the input, right? We want to minimize the expense so that the net income gets maximized, right? So that's the income statement, and the reason why it is so important, why companies use these. All right. The next is the balance sheet, right? So balance sheet, think of balance sheet as like a structural equilibrium, right? Purposefully, I'm using some of the engineering terms, not necessarily sticking to software, but using a lot of mechanical engineering terms in this session, for giving that kind of clarity, right? So the balance sheet is a financial snapshot at one frozen moment, right? It's always every financial sheet, by the way, has a point in time, right? It keeps changing pretty much every day, right? Um, so it is basically that snapshot in one frozen moment that proves the conservation of financial mass. It dictates that every single asset must be structurally funded by either taking on a liability, which means you are borrowing, right? Or utilizing the shareholder equity, which is the owner investment. So either you get liability, you are borrowing from somebody, right? Or you're using funding. Somebody is funding that financial mass that you have taken up, right? So the simple equation to remember is asset is equal to liability plus shareholder equity. You have equilibrium, it gives you that balance. Obviously, the tilt should be, where the tilt should be, right? So we'll get there in a few minutes. The other important statement in a company is basically called cash flow, right? So it actually tracks the physical cash movement to prevent corporate kind of heart stopping, right? It's like a anesthetist continuously looking at a patient's health as the operation is going on. So think of running the company as that big operation going on, and somebody looking at the cash flow is the anesthetist. They won't let, as long as the cash flow is positive, the company won't die, right? When it goes negative, still it may not, but then those are warning signs, right? The red flag has come up, somebody's waving a red flag at you. So it's basically a vital reminder that profit is not equal to cash. Okay, so think of a situation where somebody owes you money. You think that, yes, the 2000 rupees that that person has to give me is also mine. Yes, it is yours, but is it yours in your pocket today, right now? No. So from a cash perspective, you may be zero, but from a profit perspective, yes, you have booked the profit. Somebody is ready to pay you tomorrow, has not paid you yet, right? So that's the way to think about cash flow. And um, it this basically statement tracks the actual physical movement of cash through operating, investing, finance activities, you know uh, and it basically keeps things running, right? It's like blood circulation through body. None of the body parts should be starved of the blood. A strong focus on cash flow helps you do that, right? So structurally sound systems can seize up if the cash flow is not correct, or cash is trapped in unpaid invoices. That you have invoiced like 20 customers and you are going to get 20 lakh rupees, but you are going to get them after 2 months, right? Today you don't have them, and tomorrow is still unpredictable. What if the like 10 of those companies go bankrupt and they cannot pay you, right? You think that that money is with you, but it's still not with you, right? So unless it is money in the bank, don't feel happy. Okay, so just remember that one rule set as you get into corporate life. And maybe of course, applicable to personal lives also. Only feel happy when there is the money actually comes into your bank, not when somebody promises to give that money to you tomorrow. The the fourth area is various ratios, right? I call them CFO ratios, but these are ratios which we all know about, right? For example, how much mileage does your car give? Oh, my car gives me 14 kilometers per liter. How much mileage does your bike give you? My bike gives me 45 kilometers per liter. 45 kilometers per liter is a ratio, right? And you're using a ratio to track performance of a machine, right? The industry is no different. They use various ratios. I mean, I'm just going to talk about maybe one or two here, but there are at least like 50, 60 highly used ratios in the corporate world, especially in the finance teams which are in financial analysis and planning. They use these ratios very efficiently. They track these ratios, they put alerts on these ratios, and they look at all these ratios with a magnifying lens just to make sure that things are all right. I always think of this as kind of a pilot flying a plane and sitting in the cockpit. You must have seen it. Nowadays it is kind of difficult to peek inside the cockpit, but whenever you get a chance, do that. You'll find that the seat of the pilot is like surrounded with dials all around, right? And that pilot continuously cannot look at like 25 different dials and indicators at the same time, or at in a certain frequency. What the pilot does is watch out for red lights coming up, right? Wherever the red light pops up is where the pilot's attention goes, and the pilot takes care of that area, right? So that's basically the way corporates operate. They have all these ratios, which are, think of them as your CFO dashboards. Let's talk about one of these ratios, which is called profitability, right? So EBITDA percentage is basically EBITDA divided by revenue. Now, EBITDA is basically, an acronym for earnings before um, interest, tax, depreciation, and amortization, right? So you could look up a lot about why EBITDA is important. There is actually a school of thought which talks about EBT, earnings before tax, or profit before tax. So some companies adopt PBT or EBT to look at how profitable they are. Some companies adopt EBITDA because they think that depreciation, amortization, interest should also be taken into consideration. So there are various accounting principles that companies adopt. Generally, there is standardization of these principles, that but there could be like company specific nuance that people use, right? So basically, what does EBITDA measure? It measures really how much money has the company earned, right? In a layman's language, right? What is your real earning, right? If somebody asks you, oh, that's what it is. So think of it as, you're selling mangoes, right? The cost price of the mangoes is, you bought the mangoes for, let's say, 1,000 rupees a dozen, and you're selling them for 1,500 rupees a dozen. Okay, so straightway your gross profit is 500 rupees. And somebody starts asking you a question. Hey, have you taken into account your own time that it took for you to go to the wholesale market and buy these mangoes and then come down to the retail market and sell them? Oh, sorry, I didn't account for that time, my own time. And time is money, so I should put a rate on myself that each hour that I spend doing this is my rate, which means that I've already spent maybe 50 rupees, you know, doing that. Oh, have you accounted for the price of the petrol? Have you accounted for the rent of your shop? Have you accounted for the delivery charges? Have you accounted for the salary that you are going to pay? Have you accounted for the electricity bill? So once you start looking at all that, you start realizing that your profit actually is maybe 120 rupees instead of the 500 rupees that you are thinking on the sale of mangoes, right? So that's that answer of what is your real margin looking like, right? um, Liquidity is basically, assets divided by liabilities. As long as current assets exceed the current liabilities, meaning the ratio of that liquidity is 1 plus, right? The numerator should be bigger than denominator. You're good. Efficiency also is called a DSO, and we'll talk about that a little later. But for now, just remember that um, the total receivable divided by the total credit scale, credit sales over a period of time, gives you that kind of efficiency, which is called days outstanding, days sales outstanding, right? And then there is ROE, which is return on equity, and it kind of measures the ultimate efficiency and the yield of the capital that you got from your investors, right? So you got some money, right, from the investors, and how much of a return are you generating on how much of a net income are you generating on that equity, gives you that ratio of how efficient you are, right, overall. Okay, so moving to kind of how to read some of these income statements. This, by the way, you know, is Adobe's. Everybody knows Adobe company, and this is kind of the um, income statement for Adobe. You can go online and search for Adobe 10Q, and you will find this statement, right? So many listed companies, actually every listed company is required to put this kind of um, these kind of statements out there, right? um, some things to remember. We'll go through the statement in a little detail, not this one, but in a simpler explanation. But some things to remember is that both the numbers, right, the top line and the bottom line, both numbers are useful in determining how well the company is running and whether the company is healthy. They are not interchangeable. You cannot say that, oh, my top line is great, so my company is great, or doing great. My bottom line is good, so my company is healthy. You cannot say that. There are these two have to be looked at together, and in addition to that, look, several other ratios that we look at to figure out whether the company is healthy. So bottom line describes, basically how efficient the company is with its spending and managing its operating cost. So think of that situation where we were talking about selling mangoes. How efficient can you make, like, that rent, the space to sell mangoes, the time it takes to get those mangoes from the wholesale market to retail market. All of those operational aspects will bring down your bottom line, right? And how well you negotiate on the cost price also, of course. And then how well you negotiate while selling. So what's your sale price and the volume of customers. So there's so many aspects already just in mangoes. Sale of mangoes, we talked about, at least seven different things that you need to worry about. Top line, on the other hand, only indicates how effective the company is in generating sales, right? So how much of money are you bringing in, whether that top of the funnel, as it is called, whether that's efficient, right? Okay, so looking at some of these terms more specifically, kind of reading, um, this kind of income statement. What do you read typically? Your eyes should first look at what is the revenue, right? And revenue is all income a business has earned from normal business activity. So revenue could be subscription and products. Let's say, Microsoft, for example, has subscription business, and they sell products also, physical products like Xbox. um, there are so many companies who have subscription and um, products, right? Both, or license sale as they call it, right? All of the incoming money, all of the count of incoming customers, that kind of defines your top line, right? Which is revenue. The cost of revenue, which is how much did you spend to deliver that revenue, meaning how much did you spend. For example, you are using Microsoft Azure, or you are using Google Drive, right? It's a service that Google is delivering to you, and you are making use of the service. You are storing documents in Google, you are storing documents in Azure. um, the cost of delivery, meaning the cost of running those machines in the cloud, letting you authenticate, giving you all the facilities of, copy, delete, edit, everything in the cloud, all of that put together is called the cost of delivery or the cost of revenue. And revenue minus cost of revenue gives you the gross profit. Remember the 500 rupees you thought that you had earned from the mango sale? That's that gross profit. And now let's look at what other things are biting into your profit, right? So the money spent in running the overall business. So for example, the salaries, the utilities, the rent, all of that goes in operating expenses. So, in general, these are the few terms that you need to look at, or when you read of an income statement, these are some of the things that you look at. So, you go back to Adobe income statement, you see, Adobe has subscription. First of all, you'll find a pattern online that the latest of um, the revenue numbers and the financial numbers are in the leftmost column. So as you can see, February 28, 2025, and then 1 year before that, right? So this is a 3 month ending because it's a 10Q. Q is quarterly. It gave us that kind of report, right? So how much was the revenue and what is the total revenue versus what is the cost of revenue and then what is the gross profit. So look at the gross profit, looks like a big number, but then you start deducting the research and development payroll cost, the sales and marketing expenses, the general and administrative expenses, right? You pay for admin salaries, you pay for software, you pay for so many things to just operate, right, to run your business. Those are all coming in operating expense. um, so that gives you a total operating expense, and then if you reduce that from your gross profit, it starts giving you the operating income, right? And then there is non-operating income, which is the interest that you're earning or some investment gains, all of that. You reduce that from the operating income. Then there is taxes. You reduce taxes from that income, depreciation, amortization, and then what you land is that net income, right? So you could call, some people call net income as net profit or net profit percentage to derive, to look at, or to call that as the bottom line. So I have to look at net profit percentage, how much profitability is there in my business, and overall how much growth is there in my business, right? So growth is nothing but the revenue number. If you look at from March last year to February this year, this company actually has grown by about 500 million, right? So 5.1 billion to 5.7 billion is the growth of Adobe. Okay, and this quarterly, by the way. All right, so then let's get into some aspects of planning. Okay, so now you know where your company is. Okay, let's take an actual example actually. So let's say you today you are selling 1,000 pencils at 10 rupees per pencil and you make 20% profit. Okay, simple. You are selling pencils 10 rupees a piece and selling 1,000 pencils. Does that tell you where you want to be? Probably no, right? So what you do is, for yourself, you set a target that next year I want to sell 10x more. I want to sell 10,000 pencils, not the same 1,000 pencils, right? So where you want to be is going to be your target, and how you're going to get there is going to be your plan, right? You just consolidate all this and you get an annual operating plan. So which basically means that from today till same day next year, I have 12 calendar months. How am I going to increase, right? It's a point in time snapshot, right, of the financial data. So today you are at 10,000 rupees with a 20% profit. So you are selling pencils worth 10,000 rupees and you make 20,000, 2,000 rupees as profit. Same day next year, you want to be at a position of selling 1 lakh rupees worth of pencils. I don't know what the profit could be, because now the question to be answered is, how do you plan to get there? What is going to be your strategy? So so we'll take these kind of examples. This is just a kind of a starter, right, to get you oriented towards how companies plan. So let's take a case study, right? I'll let you look at this for a couple of minutes, right? Maybe a minute. Send in your questions, comments, what you see on the screen here. Obviously, it's a case study. It's a fictitious company called INF Electronics, and there are some numbers put out there, right? Take 30 seconds to a minute and tell me what you see on the screen. Okay. So our case study firm, INF Electronics is a B2B home automation company. Let's assume that they make some thermostats, sensors to turn devices in your house as uh, IoT or smart devices. Um, and they are an automation company. They are a B2B company, which means that they sell to other businesses, could be other large distributors, or could be other big OEMs, right? Let's say a refrigerator company is our customer and we sell some sensor technology, some smart home technology to that refrigerator. So the refrigerator can be Wi-Fi enabled, starts talking to our router. We can control the refrigerator's temperature from wherever we are in the world, right? So that is what our company does. Currently, we have 80 customers, 80 clients, and it generates about 120 million in revenue. This is the current snapshot with a 12% EBITDA margin and average account value of 1.5 million. Okay, so the absolute EBITDA is 14.44 million. The EBITDA margin is 12%. As we have talked about earlier, obviously the gross margin will be way higher, right? Maybe 40, 50, 60% to make a 12% EBITDA margin. This is a current snapshot. All right, now let's look at where you want to be, right? In 1 year, we set ourselves a target of 30% growth. If you look at like the bottom right corner, we have set a target for ourselves of 30% growth and 10% EBITDA margin improvement. Okay. Sorry. Yes, 30% growth and 8% profit growth. Okay. Which leads to 10% EBITDA margin. Right. So we'll come there on how that is calculated. The more importantly, to look at is we must balance the expansion velocity with the capital efficiency. So we are targeting a combined rule of 40, right? A score of 40 by pairing the 30% growth with 10% EBITDA margin improvement. So always this rule of 40 talks about growth and profitability. Growth is how much the company has grown, number of customers and the income, right? The revenue. That gives you the growth. So as you can see, our company was at 120 million. We are targeting the company to be at 156 million. So huge 30% growth is what our target is, right? So that's the growth from a top line perspective, and that's the growth percentage. The second is the profitability percentage. So EBITDA margin is basically the profitability. Now, as you guys remember, the EBITDA margin divided by the total revenue of the company is the margin percentage. We want that percentage to be 10% or higher because 30 plus 10 will give us 40%. The industry standard is that companies which are hitting this rule of 40 are healthy. Okay, and this kind of applies to larger companies. There could be some variances here and there where um, CFOs track, and some CFOs think that, yeah, I'm okay if I do 35%. Some CFOs might say, no, I'm not okay even at 50%, right? Our company is, is AI, and we have high margin business, and there are lots of customers coming in. We should target at a rule of 60. Okay. So the rule of 40 is more like a accepted benchmark of health, right? Like an accepted benchmark of health for a human body is that 72 heart rate. If you are 72 and below, then you are healthy. You're, of course, I mean, there are variations on resting heart rate versus active heart rate versus whatever, right? But that's one measure. It tells you the health measure, right? Whether you are healthy or not. If your resting heart rate is very high, you need to figure out, what is going wrong and what should you change. So your resting heart rate today, if it is 80, let's say, too high, how am I going to bring my resting heart rate down to 65? 80 to 65 is a great improvement for heart rate, right? And what are the 10 things that I'm going to do from today until 12 months from now, right? That's your plan. That's your annual operating plan. Okay. So now my question to you guys is, if you were the CFO of this company, what do you think, what are the levers in your hand? What all things can you do to move the needle of growth and to move the needle of profitability? Take 30 seconds and we'll talk again. All right. So historically, if you look at the last 3 years data, we have grown revenue from 94 to 104 to 120, and our next year target is 156. We have grown our EBITDA. Our EBITDA has been kind of fluctuating around the same number, right? The actual margin, I'm not talking percentage, right? So fluctuating around 14.16. So while we were earning 94, our EBITDA was also 14.16. While we were earning 104, our EBITDA was 14.30. While we are earning 120, our EBITDA is 14.4, and you can see that result in the EBITDA margin, right? So our margin actually is decreasing year over year. Okay. Now, in order to hit our rule of 40 next year, we want our EBITDA to grow by 8%, right? So 14.44 to 15.6 is the percentage growth of EBITDA, but it will lead to a margin growth of 10%. 30 plus 10% will help us achieve the goal, right? Now, what all our levers, right? I mean, you guys talked about a few, but now from a company perspective, let me see if I can unroll a few more, right? How to look at this. So high growth allows for near term cash burn, while slow growth mandates high cash generation. So how do you do that, right? How do you balance that equation? If you run too fast, you are going to burn a lot of engine fuel. If you drive too fast, you are going to burn a lot of engine fuel, which will leave you with much less, right? Until there is new addition coming in, but it will get you from point A to point B quicker. On the other hand, if you drive your vehicle in that economy zone, you will get longer distance, but over a longer period of time. So how do you balance that equation, right? So high growth or slow growth with higher margin. That's kind of the conundrum. So let's look at some of these levers, the way companies think that if I have to grow 30% and at the same time try to conserve as much as I can from my profits, what I'm going to do is I'm going to invest. My current products are giving me the 12% EBITDA that I'm getting. What I'm going to do is harvest that core. Okay. So cash generated from my mature products, my domestic market operation, I'm going to harvest. Okay. And I'll uh, basically harvest is you take that cash from those products and move into future products which are going to help your growth, right? So let's say in your home automation business you have six different products. What you want to do, or what your goal is that those three products which are you're not planning to invest, it has reached kind of a state of maturity, you will stop investing in those products, you will milk them. Okay, those become your cash cows. You take the cash that you're getting from those products, the margin that is from those products, and you're going to invest that in products which are AI enabled for the future, voice enabled, or newer products which talk to newer IoT devices. Remember, we are a home automation company, right? So the so that the new products can bring in new customers, the enhancement of AI to my old products can bring in more revenue from old customers. So always, the same game is played even in corporates. You want to bring in new customers, net new customers, and retain old customers, and service some customers who actually don't fall in these two categories, right? When I say service, there are always customers you will find in your corporate business who are not seeking for anything new from you. They're happy with your current product. They just like want you to continue maintaining that product, and we'll service those also, right? So the way to now look at is the funneling of extracted cash directly into capital heavy. So I'm going to invest in R&D, but not so. See, I mean, R&D can be invested. When I say R&D, I'm talking about engineering, right? So within engineering, I could invest my time fixing bugs in my old software or writing new software. Here we have taken a decision that we will invest writing new software or invest in new technology, new products, right? We will not put a lot of focus on old products. So that is going to be our harvest and build strategy. We harvest the core, extract the cash from those mature three product lines, and then we are going to fuel the frontier, meaning we are going to put that money into the three um, next generation products, let's call them, or new products which we have on mind, right? The other thing could be, with the same products, what if I say that, I don't need to spend a lot of money on R&D for these three products, because today I'm selling in India. What about selling in Southeast Asia, right? It's kind of a similar market to India, but the technology adoption in the hands of end customers is quite high. So I think, I'll be able to sell in Southeast Asia. Let me pick maybe three or four countries which, in addition to India, to go sell my product, which again means that I don't have to invest in R&D, but I will have to invest in, sales and marketing, right? Because this is new territory now. I have to find new customers in a new territory. All right. So that's one lever. So we talked about how one kind of planning that can happen. What is the other planning, right? So cost of goods sold. If you remember, we are talking about a home automation company. We are talking about our mango example. If you guys remember, right? So the cost of getting those mangoes from the wholesale market to my shop, right? How can I make that more efficient? So driving down manufacturing cost, optimizing, production efficiency. I will replace some of the manual processes with automation, and which will give me better quality. And that automation I'm going to purchase second hand, because somebody else already um, wants to get out of this business. I don't want to buy new machines. I don't want to put in my profits or good money at old products. So my trade off there is that I will buy used equipment, I will do some automation, and drive the manufacturing cost down, right? I will negotiate again with some of my vendors to see if those vendors can give me better costing. Okay. um, so that will give me some operating, some better efficiency when I'm producing my goods, right? So I'm going to, one thing is, how do I accelerate on my growth, how do I decelerate on my cost, right? So where can I find savings is the strategy here. So tightening the belt, it's basically uh, getting defensive on the operating expenses. So maybe I don't need um, X amount of engineering headcount on my old product. So if I am a company where there are 30 engineers, the electronics and telecommunication engineers, software engineers, hardware engineers, all of them working, let's say a team of 30 working on my product lines, and 15 out of them work, or 20 out of them work on my current product lines. What I will do is I will reverse the ratio. Until today, 10 were working on my future products, 20 were working on my current products. I will reverse the ratio. I will move 10 people to work on my current products and 20 to move on my future products. That's basically tightening the belt on my current. Okay, I'm not tightening the belt on my future, but I'm being very judicious on the spend that I do on my current products. Okay. And the financial impact is, the general and administration is restricted to 7%. Okay, so now we are slowly getting into the zone where every small piece of change that I'm going to do over this 1 year's time is going to contribute its own small percentage towards my big goals. My big goals are 30% growth, 10% profitability improvement. Okay, so that's my strategy from operational expense perspective. And then there is offensive levers. When I say offensive levers, is that where am I going to attack? Where am I going to put in all my energy and get the maximum out? First is sales and marketing. First offensive lever is sales and marketing, because now if I have picked Malaysia, Indonesia, and Philippines as the target countries, the new countries that I have to go after, I have to do a full market research, a product market fit analysis. Maybe there is some localization to be done for that product. I have to figure out, how am I going to advertise myself, set up my entity there, build my brand, build brand loyalty in that country, so that people start looking at my product. So who are the top 5 businesses that I'm going to approach, for example, right? Remember, we are a B2B kind of product line. So who are the top 5 that I approach, and how do I approach, how do I get to them, so that I start getting business in those countries. I have to put a lot of cash out of my pocket to be able to do that. I have to send people to all these various countries, put up offices there, spend on brand marketing, spend on product marketing, and so on, right? The next offensive lever that I'm going to use is basically um, how much of that shift we kind of talked about, right? So how much do I scale my R&D operations so that it helps me, um, it helps me focus on my new products. So far I was just like keeping my current customers happy by focusing on current product lines. Now the offensive strategy is that I'm going to aggressively build new products and go after my old customers selling these new products, plus go after net new markets, right? But now with this kind of strategy, I'm moving those engineering dollars. Remember, I'm moving 10 people from my current team to the next generation team. Okay, so that's the other lever. Okay, so these are now the three strategies, right? So going back to this question, right, and this is where the best planning happens. If you are a CEO, how will you get there? This is my high level answer, right? So harvest in India, right? Whatever is the cash cow products, I'm going to squeeze this mature market. I'm going to move some of my R&D resources. I'm going to drive down manufacturing cost, and I'm going to move these funds into new products which are, let's call them AI enabled R&D products. And it's going to be multi-year. It's going to take me time to kind of build that kind of technology out, and then I'm going to also at the in parallel focus on the Southeast Asia market, so that I get net new markets, net new customers. So this is basically our strategy, which uses our three initiatives, different time horizons. One giving us immediate cash flow, the other, you know, give us an understanding of how the cash burn happens, and then a multi-year capital sink on AI. All right. So a fixed top line target of 30% growth mathematically locks our operating guardrails, right? So remember, 120 million is all right. Let's look at how the same operating plan looks like from a financial simulation perspective, and this is the kind of graph that companies use to figure out how are they going to fill up those gaps, right? And where are they going to deploy that capital. So it's a visual simulation showing the step down from how that 156 million target, right, breaks down through optimized COGS, cost of goods sold, through our new territory that we are going to sell, right, which is SEA, Southeast Asia, and through the new aggressive strategy on the AI roadmap, right? How are we going to hit that, all those numbers? So you start reducing 156 million, take out that orange part from that 156, take out the orange part from that 101, take out R&D, take out general and administration, and you are left with 15.6 million as EBITDA, right? So 156 million revenue and 15.6 million EBITDA will give us our rule of 40, and we are then going to be called a healthy company. Okay, this is just another way of looking at the new revenue and its primary drivers by geographic expansion, targeting maybe 5 B2B clients per new country, and average size of 1.5 million, average size ticket. How am I going to go after that 22.5 million net new business? The yellow line talks about my savings on, or where am I going to deploy that capital, or that gap, right? That 15.6 million gap is going to be filled by primarily these three things. That's the depiction. All right. So as you can see, it is a collective, it's a team effort, right? And how much small things each team contributes kind of leads to that large effort. So won't go in a lot of detail in this slide, but in the AI features that the engineering is going to build, the new AI features that the engineering is going to build, plus the next gen automation that they are going to build, is going to contribute towards 15% of sales. Meaning the sales guys are saying that if you build this, we'll be able to get the same customers buy more or get net new customers, right? Either way, I'm going to help improve sales because of this. I think I'll be able to do 11.25 million out of this, and it is this, from a strategy perspective, it aligns with our SEA expansion goal, right? Southeast Asia expansion goal. The next department is again engineering. Engineering is saying that I'm going to be on a defensive strategy on my current products, and that's aligned with our Harvest India strategic alignment. And I will save 3.75 million, right? The marketing says that I'm going to do some e-commerce optimization, change some images, change some branding, change the way we present our product to customers, all of that, and that will bring in 4% new sales, right? So 3 million out of the total sales will be towards e-commerce optimization. 3.75 million will be towards corporate branding, and so on. So every person in that team, I'm not talking, I mean, every department itself is a team, but even every person within that department, individual contributions start accumulating rapidly and they help towards the top goal, right? This is a ladder, and this is one of the reasons why you should know which department are you sitting, right? And what is the output metric that people are looking at. It will help you look at whether your work is towards a strategic initiative in the company, and how much of your work is causing what kind of financial impact, right? This is the engineering and marketing commitments towards that 30% top line, and the same commitments from manufacturing and engineering towards 10% EBITDA safeguard, right? So with this kind of plan, and by the way, this is actually on a PowerPoint presentation. This looks more like a board presentation, or an internal all hands presentation. But all of this financial planning, mapping, all of this is done on a month over month basis, at a customer by customer basis, at a product by product basis, and so on. um, you know uh, that's kind of the we only see the aggregate summary, which we call as income statements, but there are so many data streams that feed into this, right? So with every department, when every department adheres to their commitments, the ledger balances, and the company successfully executes its strategy by landing perfectly at the rule of 40. Okay, so we only looked at one rule which talks about a healthy company, but that rule has so many things inside, right? We are talking about growth percentage, we are talking about margin growth percentage, right? Within growth, how are we going to do it? What is our offensive strategy? What is our defense strategy? Within margin, how are we going to save, and how are we going to upsell and new sell, which helps our margins. So there are so many strategies which get embedded just because of this one rule that the CEO has set up for the company. And that's how it typically works in large organizations. At a strategic imperative level, there are not more than one or two strategic imperatives, high level imperatives, that the CEO and the CFO of the company set, and the whole company rallies after those goals. So this is how an annual operating roadmap looks like, overall, where we start, what we do, what are our strategic priorities, how do we operate, and what kind of profits do we bring in, what kind of growth do we bring in. Okay, so we talked about a lot about understanding of financial statements, which is very important for you to understand how the companies are doing, or how my company is doing, and helps you take meaningful actions on what is important to the company, helps you take meaningful actions on decisions, right? What are my levers? what are my trade-offs, and what is my personal contribution. How does my work kind of ladder up to the company goals, right? So that was pretty much the presentation for today. Thank you very much. Thanks for your time. There is vast amount of data available on both understanding company financials, and you are well aware of so many websites now, which help you do that. There is not so much, but there is enough, still enough data available about annual operating plan. What are the key ingredients of these plans? Now, the content of all these slides is Satkam's content, but I'm also thankful to Notebook LM to quickly put all of this, help beautifying these slides and putting the nice graphic around every slide and so on. That's not something which I sat down and I did manually. I used Notebook LM to do that, but the content is all Satkam. Thank you, and you guys have a nice day. Bye. Hi. So you can start the quiz, and then there is a attendance sheet as well. Some of you, forget to do attendance. So there are two different forms that you got to submit. One is for the quiz, and the other one is for the attendance, right? So you have until 4 p.m. I'll be here to answer any questions that you have. So feel free. There are some questions which were asked earlier. Um, Obviously, somebody was joking about Ponzi scheme and how to make money faster and all those kind of things. Remember, guys, there is no shortcut to success. Okay, only hard work can bring you there. If you guys open yahoo.finance.com and type in the name of a company, let's say Adobe or Zomato or Netflix, and study their financial results, a lot of what I'm discussing here is actually stated there. And they also talk about various things around how company looks at these finances, what to look for in a balance sheet and so on, right? So you may want to do that, you know um, as a homework. The best way is to go to Money Control or Value Research or Google Finance or Yahoo Finance, and search for some of these terms, search for uh, reports. It could even help you in interviews, right? I mean, if somebody wants to, or you has called you for an interview, the best approach that I would take is study the finances of the company, prepare a good list of 5 to 6 questions based on those finances. Why is the company investing in Indonesia? Why not Malaysia? Why only so much growth in India? So there could be so many questions that you can ask the interviewer. And it to me, I have actually interviewed thousands of students as well as other employees, other experienced people also. And one of the things which has always impressed me is how much of an understanding does the interview have about my company, right? So that's just another tip for you as you start learning finances. Thanks. So I'll keep myself on mute, but I'll be here if you have questions. Feel free to ask, but attempt the quiz as well, and mark your attendance on the sheet. Thanks.